following is a paid program. The opinions expressed are not necessarily those of WNBU and Interbanks Media. Welcome to All Things Money with David Blain, a thoughtful and revealing discussion of actionable ideas and effective strategies to help you through the complex world of investing, taxes, and real estate. Now, with All Things Money, here's David Blain.
Hello and welcome to All Things Money. I'm your host for the show, David Blain. Thank you for joining us today on 94.1 FM, WNBU, and Cable TV 10 in New Bern. We are glad to have you. If you have any comments or questions on the show, that's where our ideas generally come from the show. Viewers and listeners emailing, calling, visiting us on the web. Let us know what you're thinking, questions you may have on something we talked about, or a new topic you'd like to see addressed. You can email us at allthingsmoney@dlblain.com. That's allthingsmoney@dlblain.com. We still use the old-fashioned telephone. The number is 252-633-0107. And you can visit us on the web on our website, www.dlblain.com. And I really encourage you to visit the site. We've recently redone it. Even if you don't have any comments or questions on the show, if you're just looking for some good information, we have cataloged and indexed years and years worth of articles, things that have been written in the news, published in Wall Street Journal, magazines, things like that, things we've published and sent out to our clients on our own. We've also cataloged all the radio and TV shows, just a wealth of information on there that we'd encourage you to check out. Okay, so for today's show, we want to talk a little bit about some basic investment advice. Every few shows, every 3-4 shows, I try to give just some basic time-tested principles of investing. If you listen every week, what I would say to you is you can't hear these enough. And if you're just tuning in, then it's good timing, because these are some timeless principles that we think everyone would benefit from following. One of the biggest hazards to investing, I think, is the way that investing is sort of turned into this sport. There's some sort of score at the end of every day, whether you won or lost. And the same thing with companies, the way they report their quarterly earnings or something like that. If you're a household, looking at your monthly income versus outgo, did you spend more than you made? Investing is not a monthly activity. It is not a daily activity that you need to keep score at the end of the day, like on Sunday after all the games have been played in the NFL and you see who won and who lost and what the standings are. You don't do that in investing. This is not a daily or weekly event. It's not a monthly event where you see, did you win or lose that month? I mean, it's okay to look at, but that's not how you judge investing. Investing is a long-term endeavor. It is something that you should endeavor from a very young age through your entire lifetime to a very old age. And then hopefully, if you've done it correctly, you've accumulated more money than you can spend, and then that money continues to be invested for future generations. That's the way we like to approach investing. It's very difficult when you have a Wall Street Journal, CNBC, every day coming out with new news and a new crisis, and this company doing this and that company doing that. And so I want to try to focus you in on a few things. Number one is look at history as a guide. History is not a perfect guide, but it's pretty accurate. When we were going through the financial crisis of 2008, do you realize that was not actually a very unusual event for the stock market? That it was certainly at the outer edges of it, but we've had declines like that before. And when you look at these different bubbles, go back to 2000, and you hear this proclamation of this time is different, when you start hearing those type of things, that's when you should get nervous. And that it is important to study the history of markets. not just the U.S. stock market, but all the way back to, there are things like the South Sea bubble, when people in the 1500s were investing in the new route to China and India, and the tulip bulb mania. And there are history, and the reason is because investing is about people. Investing is about human nature, and human nature's tendency for fear and greed. And that's why history, if you look at long enough periods of time, you see these certain patterns and consistency in investing, because at its heart, investing is about fear and greed, which are human characteristics that generally don't change over time. You know, sure, the companies come and go and the techniques come and go, but the reality is people striving for something more than they have is a human trait. So we encourage you to study history. Whenever you hear things about, well, it's permanently bad or it's a permanently higher level of something, especially when it's coming from, you know, a governmental body like the Federal Reserve, we get really, really nervous. The market is very inefficient in the short run and will tend to veer from fair value and can stay that way for quite some time. But inevitably, after confounding most investors and just exasperating people, it will return to fair value at some point. A lot of times it overshoots fair value going the other direction. And for people, professionals in the business, it creates two problems, because you have your investment where you're trying to focus on the long term, and then you're also trying to run a business. And so as I go through some of these things, keep in mind, if you're doing it yourself, the other thing that we a lot of times recommend, for reasons we'll talk about, is if you hire somebody, you've got to give them enough latitude to do what's best for you in the long term. If you're constantly worrying about, you know, how you did this month or this quarter, what happens in the investment industry, especially the mutual fund industry and the money managers out there, is that they get wrapped up around these quarterly numbers, and they tend to manage around the benchmark. They tend to manage around these quarterly figures, which can actually be detrimental to your long-term financial health. Is that you want the manager to take a long view and not to be overly focused on the short term. One thing we've talked about before, I'll just kind of throw in here as well. Another principle is to not borrow to invest money, especially not into the stock market or something like that. It's just a very, very dangerous thing to do, is to borrow money to invest in any sort of speculative endeavor. Well, we're coming up on our first break. When we come back after a few short messages, we'll continue talking about some timeless investing principles that apply to everyone. So for All Things Money, I'm your host, David Blain. We'll